The big beautiful bill, as it's being called, has been passed and signed into law. And that means that after September, the $7,500 tax credit for electric vehicles that Tesla has been the biggest beneficiary is going to be eliminated. On top of that, Tesla's sales have been in decline for months now. It's pretty hard to see a light at the end of the tunnel for Tesla, at least operationally. Now, this is a company that's still worth almost $1 trillion. So there's a lot of confidence in what Elon Musk can do in the future. But if we just look at their business, it is doing absolutely terribly right now. So I want to dig through the recent numbers that we got and why this is really bad news for Tesla's profitability as we go through 2025 and then into 2026 as well. Is FSD, is some sort of a robo-taxi service going to save the day? I don't think so. The tests in Austin are not going particularly well right now, but let's dig into it. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's first start with the chart that just shows exactly how bad Tesla's deliveries have gotten recently. And what you see here is deliveries in red, 384,122 deliveries in the second quarter of 2025. That is global. That is not just a US number. That's the company's total deliveries all around the world. That is down from 443,956 a year ago. Now, this is an increase from the first quarter. So if you want to look for a silver lining, that would be the silver lining in these numbers. But the other thing we need to think about is their production versus their deliveries. That's going to give you what their inventory looks like. Inventory is a challenge for automakers because it sucks cash out of the balance sheet. If you're making more vehicles than you're able to sell, that's money that you're spending on vehicles and not getting a return on that investment. It also can lead to discounting, so even worse margins in the future. So that's what we know after the second quarter of 2025, is that operations are not going well, sales continue to fall. It's likely that Tesla is going to be seeing a pretty significant drop in net income again in the second quarter. That is following a pretty weak first quarter as well. But there's a couple of things that we need to think about going forward. First, the $7,500 tax credit is going to be going away after the third quarter of 2025. So there may actually be a surge of sales for electric vehicles in the third quarter. But after that, those prices are likely going to have to increase by $7,500 because that tax credit's not going to be available. I don't think that Tesla has the ability to raise prices like that. So that means they're going to essentially have to take the hit. And that is going to mean their profitability is going to go down dramatically. This is the problem right now for electric vehicles. They have relied on the $7,500 tax credit for years. There is no company that has benefited more from those tax credits than Tesla. But now that the tax credit is going to be going away for everybody, there's nothing for Tesla to fall back on. Companies like General Motors and Ford can just say, you know what, we'll make it up in ICE production. But here's the thing that not a lot of people are talking about right now. That is not the only pressure that we're going to see from Tesla's results. A bill that was passed in May may make it harder for California to demand that companies have zero emission vehicle credits. Those credits have been a huge beneficiary for Tesla. That's basically free money that the company gets just for making only electric vehicles. Other automakers need to buy those credits, and that has meant hundreds of millions of dollars of benefit from Tesla. Without those credits, and the credits that I'm showing here are worldwide credits. We don't know exactly what the breakdown is of each country or each region, but those credits have driven Tesla's profitability. Without them, the company would have lost money in the first quarter of 2025. So it's very possible that by the end of this year, definitely into 2026, we're going to see less value from those credits. I also think we're seeing some pressure to reduce some of those mandates in Europe as well.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
The big problem for Tesla is that their demand is down. Their inventory is building. The subsidy that has helped make electric vehicles economical for people to buy are going away. And the tax credits that have driven the company's profitability could be eliminated, at least in part, over the next few quarters. So what does all of this mean for Tesla stock? That's really the trillion-dollar question for investors right now. If you go back through the history of Tesla, I think what you've seen is Elon Musk has been able to make the vision bigger and bigger and has been able to show growth. If a company is growing, you can overlook a lot of warts that may be going on underneath. But Tesla is no longer a growth company. The company's revenue is in decline. The one bright spot, the energy storage business, could really be under pressure as some provisions that are part of the recent big beautiful bill are going to make it more difficult for them to import batteries from China. Those batteries from China made up a vast majority of the batteries that were going into energy storage products. That was the high margin, high growth business that Tesla had over the last couple of years. That may be going away. Not all the subsidies for making cells into packs and things like that are going away in the US. So some of those subsidies are going to remain, but it's unlikely that the momentum that we've seen in the energy storage business is going to continue with some of those importing provisions. It's also not clear that robotaxi is going to be anything meaningful for the company over the next few years. The tests that are going on in Austin don't seem to be going particularly well. It definitely isn't something that's going to scale even in Austin all that widely. Sounds like they're mapping some more areas, but I wouldn't count on that to be a huge revenue driver in 2025 or 2026. Despite all that, there's lots of other competitors who are bringing autonomous vehicles to market. Waymo continues to add city after city in their plans to scale their business. We've seen Volkswagen's Moya, which is powered by Mobileye. They're going to be launching in a couple of cities in the US next year. So this is not the only game in town when it comes to autonomous driving. That's really the challenge for Tesla. The core business, the auto business, continues to decline with no real end in that decline in sight. And some of the future products just don't seem to be what a lot of investors thought. So while the vision was getting bigger and bigger when Tesla's stock went up, now reality is hitting. Now we've hit the point where they need to actually deliver on that vision. And I think that's where things really become problematic. At the end of the day, this is an automaker. They are making cars. They need to be able to manufacture those vehicles and sell those vehicles at a profit. This is not a phone manufacturer. There is no platform. There is no app store. Tesla is more comparable to General Motors than it is to Apple. It has not been valued that way by the market, but operationally, that's exactly what this company is. And I think that is going to come back to bite Tesla's investors over the next few years as they realize that this growth story just isn't going to come. Tesla vehicles are not getting more profitable. And by the way, competitors are coming, even in the US. There are a ton of competitors in China. I think that business is going to be more and more troublesome for Tesla over the next few years. But even in the US, General Motors reported a 134% increase in electric vehicle sales in the first half of 2025. They're up to now a 16% market share. That's about the same market share that they have in regular ICE vehicles. That's going to mean less demand for those zero emission vehicle credits, and it's going to mean more competition when people actually go to buy vehicles. I actually looked up this Equinox EV, which you can see right here. You can get one today for about $24,000, including that tax credit. That's less than you would pay for a Tesla today. So things have really changed for Tesla over just the last couple of years, and the stock doesn't really reflect it. But I think this is one that investors really want to consider cashing it in. If you're an investor in Tesla, you got to consider, what does the future look like? And I think the future is looking bleaker and bleaker by the day. But let me know your thoughts in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.